In 2022, Ark Invest and its founder Cathie Wood saw a significant decline in the performance of their flagship Ark Innovation ETF. This was a major surprise as the fund had previously been one of the best performers in the market with assets totaling over $50 billion. The fall of the ETF can be attributed to Wood's investment strategy of buying stocks that she views as innovative regardless of their financial performance or valuations. This led to a portfolio of companies that were almost all losing money, which proved to be a recipe for disaster as interest rates began to rise. Critics of Wood's strategy have argued that her disregard for financial performance and valuations has resulted in large losses for her clients, most of whom are individual investors. They argue that Wood's portfolio looks like a disaster, with the vast majority of her stock reporting negative EBITDA according to generally accepted accounting principles or GAAP. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is widely viewed as a metric for core profitability of a company, and on this metric, Wood's portfolio does not look favorable. However, Wood has defended their strategy and claims that traditional investors and valuation methods fail to recognize the true value of her disruptive innovation stocks. She argues that these stocks represent deep value despite most of them not having any earnings at all. Wood has also created a new metric, adjusted EBITDA, which she uses to show that the majority of her stocks are in fact profitable. But the problem with this is that adjusted financial metrics are not standardized, meaning that different analysts can make adjustments and come up with different results. Cathie Wood's investment strategy, which is heavily focused on buying stock that she views as innovative, regardless of their financial performance or valuations, has led to a significant decline in the performance of the Ark Innovation ETF. Critics argue that this strategy is flawed and has resulted in large losses for her clients. However, Wood remains confident in her strategy and argues that traditional investors and valuation methods do not understand the true value of her disruptive innovation stocks. The use of non-standardized metrics such as adjusted EBITDA further complicates the picture. So, in this video, we'll explore the intricacies of Cathie Wood's methodology for adjusted EBITDA and assess the validity of her adjustments. In her analysis of reported earnings, Cathie Wood makes several adjustments to align the numbers with her investment strategy. Firstly, she adjusts the ratio of research and development expenses to revenue to match that of companies in the Nasdaq 100. She argues that early-stage technology companies have to spend a larger proportion of their revenue on R&D in order to drive future growth. Similarly, she makes adjustments for sales and marketing expenses and stock-based compensation. She also argues that these expenses are investments in a company's future rather than current expenses. She then removes non-cash impairment charges and treats deferred revenue as actual revenue. Wood's adjustments make sense in some aspects, as it's true that early-stage tech startups often need to spend more on R&D and sales to drive future revenue and growth. However, the argument of stock-based compensation as investment is more questionable. While it's true that tech startups may use stock-based compensation to attract top talent, this is also a common practice among established companies who can afford to pay high cash salaries. The key difference is that mature companies have more cash available, whereas startups often have to rely on stock-based compensation due to lack of cash. While companies have the ability to issue as much stock as they want, it is not without cost, and this is something that should be taken into consideration when evaluating the company's financials. Cathie Wood's adjustments to reported earnings numbers has led to questions about the validity of her methodology. One of the Ark portfolio companies, Shopify, has been losing money for years and has been conserving cash by heavily relying on stock-based compensation, which has significantly diluted the ownership stakes of existing shareholders. This is real economic cost and doesn't matter whether employees are paid in cash or stock. Another adjustment that Wood makes is removing non-cash impairments, which is most financial analysts do, and it is not a controversial move. However, Wood's decision to treat deferred revenue as actual revenue when calculating her adjusted EBITDA is a more controversial move and raises questions about the validity of her adjustments. This means that revenue has not yet been earned is treated as if has already been earned, which does not accurately reflect the company's current financial situation. Imagine you're a landlord of a vacation home that you rent out through Airbnb. A tenant books a stay in your property 3 months in advance and pays the rental fee right away. Even though you've received the payment, you haven't provided the service yet. According to GAAP accounting rules, this money is considered deferred revenue and it doesn't show up in your income statement yet. You only recognize the revenue once the tenant has completed their stay in your property. This is because, in accounting, you only recognize revenue once you have provided the good or service. While it might sound like a minor accounting detail, the timing of when you recognize revenue can have a significant impact on companies' reported profitability. This is why Cathie Wood wants to recognize deferred revenue immediately. Her adjustments make almost of all Ark Invest's unprofitable companies appear profitable, and this raised a red flag about the accuracy of the profitability numbers. Now, before we continue, I'd like to thank you for getting this far, and if you want to see example of Cathie Wood's method, then make sure to watch this next part. Let's take a look at Roblox. In examination of its financial performance, it was revealed that the company underwent a significant shift in its earnings. It moved from substantial loss of $650 million to a profit of $600 million through the application of adjustments suggested by Cathie Wood. This data pertains to its fiscal year ending September 30, 2022, as recorded in their official financial statements. During this duration, the firm generated roughly $2.2 billion in revenue. And after deducing all expenses and factoring in non-cash depreciation and amortization expense, they were left a negative earnings before interest, taxes, depreciation and amortization, a GAAP EBITDA of $652 million, indicating a loss. However, by applying Wood's proposed adjustments, Roblox EBITDA transformed to a positive $602 million, a staggering difference of $1.2 billion when compared to their GAAP EBITDA. Now, an in-depth analysis reveals that this surge in profits can be attributed to several adjustments made by Wood. For example, she lowered the company's R&D budget, which was initially 36% of its revenue, bringing in line with the industry average of 12%. Additionally, Roblox's expenditure on sales and marketing, which was already low at 5% of revenue, was lowered even further. This could be due to the vast amount of user-generated content on platforms like YouTube that negates the need for extensive paid advertising. Furthermore, Wood also made adjustment to the company's expenditure on stock-based compensation and treatment of deferred revenue. In the end, the adjustments proposed by Cathie Wood resulted in a significant increase in Roblox EBITDA. However, it's important to note that these adjustments may not always align with the economic reality and must be evaluated accordingly. Adjusting a company's finances can be a delicate task, and it seems that Cathie Wood's adjustments to Roblox finances may not always be accurate. Wood's adjustments to research and development, sales and marketing, and stock-based compensation aim to align the company's expenses with the industry average. However, there is a problem with how she handles stock-based compensation. Stock-based compensation is a common practice in which employees are given company stock as part of their compensation package. This stock-based compensation expense is then allocated to the department where the employee works. In the case of Roblox, a large percentage of stock-based compensation is given to employees who work in research and development. So when Wood makes adjustments to both the research and development expenses as well as stock-based compensation, she is double counting the adjustment. Moreover, Wood's adjustment of treating $528 million worth of deferred revenue as if it were already recognized is problematic. Roblox generates most of its revenue by selling in-game virtual currency, Robux, to its users. These users can then use the Robux to purchase in-game items such as skins for their avatars and tools they can use in-game. However, it can take a player months or even years to spend the Robux they purchase, and because of this, Roblox almost always has a large amount of deferred revenue. Cathie Wood's adjustment may not always be in line with the economic reality of Roblox financial and should be evaluated accordingly. The company's stock-based compensation and deferred revenue are examples of areas where Wood's adjustment may not align with the actual financials. Adjusting a company's finances to present a more favorable picture can be tempting, but in reality, it may not be an accurate representation of the company's financial performance. This is especially true in the case of Cathie Wood's adjustments to Roblox's finances. On the surface, recognizing deferred revenue as if it were already recognized might seem like a good idea, but in the case of Roblox, there are two significant issues with this approach. Firstly, Roblox distributes its products on third-party platforms like Apple App Store for the mobile version of its game. These platforms typically charge a significant fee for in-app purchases, which can eat into Roblox's revenue. Secondly, a significant portion of Roblox's revenue also goes to third-party developers who create games on the platform, further reducing the revenue that reaches the company's bottom line. Furthermore, Wood's adjusted EBITDA metric does not take into account the deferred cost of revenue or other variable expenses. This means means that by pulling forward revenue without pulling forward expenses associated with that revenue, a false picture of the company's financial performance is being painted. Adjusting for double counting of stock-based compensation, as well as deferred cost of revenue and developers' revenue share, Roblox's adjusted EBITDA decreases to a negative $56 million. It is worth noting that Wood applies the same flawed methodology to inflate the EBITDA of all her portfolio positions. Even after applying of all Wood's adjustments, many of her portfolio companies are still unprofitable, with some of these stocks having lost more than 90% of their value. It's not just Roblox that have negative profitability, even companies like DraftKings, Robinhood, and some biotech companies still unprofitable. The financial status of Ark's portfolio companies is precious, and with the current rate of cash burn, many of Ark's portfolio companies may go bankrupt within a few years. And some with these stocks having lost more than 90% of their value, it'll be very difficult for them to raise additional capital. Out of the 24 companies in her portfolio, 11 of them have less than 4 years worth of cash on hand. And one of her companies, Invite, has less than 1.5 years of cash on hand. It's clear that Wood's adjustments are not only unjustifiable, but also divorced from economic reality, and the true financial performance of these companies may not be as rosy as they appear. Fortune smiled upon Cathie Wood as she made a shrewd move by investing early in this innovative automaker, Tesla, reaping substantial returns as a result. However, her subsequent investment decisions have proven to be flawed, resulting in staggering financial losses for her clients, running into tens of billions of dollars. So, what are your thoughts on Cathie Wood's performance as an investor and how she's handling her stock portfolios? Let me know what you think in the comment section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you want to know more about Cathie Wood and her investments, make sure to click and watch the next video right here and enjoy. And that's the end of this video, guys. See you next time.